Welcome, everyone, to our first Zoom interview. So we've really been looking forward to this at AdvisorHub, and very happy to have Marty Bicknell and Shirl Penney with us today. Welcome, gentlemen.
Thanks for having me.
That was kind of a mumble, but yes, we'll continue on because we're going to pretend this is live. So that's great. So you two obviously know each other and are good friends, but you're also now business partners. You want to tell me a little bit about that? We'll start with Marty.
Yeah, sure. So we are business partners. Mariner is launching a new strategy called Mariner Platform Solutions that gives us the opportunity to serve a different segment of advisors than we've served in the past. And we made this strategic decision instead of trying to build the middle and back office structure ourselves again, like we've done with the original entity. We decided to partner with Dynasty and have them provide that for us as we go and launch this together.
It's really a first-class platform. I love what you've done over there, Shirl. What does this partnership do for you?
Yeah, and I like the fact, Tony, that you brought up, thank you, that Marty and I have been friends for a number of years. More importantly, our wives are friends. So it was easy for us to get together and work out a business partnership. But I had a lot of respect for Marty over the years. I think he's one of the finest entrepreneurs in the RIA ecosystem. 14 years ago, breaks away, launches a business with 3 advisors that now has over 300 advisors, 700 employees, almost 40 billion in assets. So I've been at him for a while as a friend to figure out a way for us to work together. And what it means for us and why we're excited about it is we're getting a lot of calls, Tony, from that $100 to $250 million advisor that maybe is at a wirehouse and wants all the benefits of independence but doesn't want to run their own business, or they feel like they've outgrown their more retail IBD chassis and they want to make a move to a more RIA-centric type model, or frankly, with smaller RIAs that aren't having as much fun anymore running the business, but really love advising clients. And they're looking to get synthetic scale by joining a larger organization, but maybe they don't want to sell quite yet, right? So now they get to come in and get all the benefits of Mariner's brand, their size, their business development support, practice management, all their investment team members, and then all the benefit of Dynasty in the middle and back office to provide all the services that really free them up to spend more time with clients and to go grow their business by getting your clients.
Your average, I mean, typically a Dynasty producer would be like a guy doing 2 million or something, typically, right, prior to this?
Well, the average team on our platform actually now is closer to 750 million.
Right.
So it's really great. They're a private wealth management type team.
And these guys who are coming in with Mariner, what I love, Marty, about what Shirl has built, the interesting stuff is, if you want to get plain financing or you have your art and antique stuff, you can do it through him. And even a producer who's a sort of, $100 million producer, they probably have 1 or 2 clients that can benefit from that. Can they use that stuff?
They can, absolutely. They'll have access to the broader platform. But what I think is very interesting, and Marty should speak to it, is what he's built really is a diversified financial firm that has great capability in tax and trust and investment banking within the Mariner family, which I think is going to fit the need of 90% of what the advisors on Mariner's platform solution will need. But the one-off where they need something that maybe they can't do in the family, absolutely they'll have access to the broader Dynasty platform. Marty?
Yeah, no, I think you hit the nail on the head. I think the way we look at it, the difference between Mariner Wealth Advisors and Mariner Platform Solutions is really they're 2 separate entities, 2 separate LLCs, 2 separate ADVs. And on the platform side, the advisors will become IARs, independent advisor reps of Mariner Platform Solutions, but they own their own entity. It has their own brand, right, but they get access to everything we've built for our employee-based model. So as Shirl said, we have 120 tax professionals at their disposal. We have a trust company. We have an insurance general agency. We have a boutique investment bank for the closely held business owners, so they don't have to worry about, some of the competitors that do that coming in and getting access to that liquidity event. And all of these different things are built for our advisors, both at Mariner Wealth Advisors and NPS, so that they can have the solutions at their fingertips, instead of having to go figure it out on their own and figure out how to outsource it on their own.
So you have to be pretty excited about it, Marty, and so excited that you also made an investment in the firm.
Yeah, in Dynasty we did. So my personal family office made an investment into Dynasty. I tell you, we went into this. Obviously this wasn't part of the intent, but as we were trying to figure out this solution and working with Shirl and working with Shirl's team, we really got excited about their business, yeah, and where it's headed. I mean, when I take a step back and think about this space in general, I mean, I'm so bullish on where it's headed, right, and really in all aspects of it. And people have talked a lot for years about the growth of the space. I'm still a firm believer that we are still very early stage, and being able to think about having an opportunity to continue to grow through acquisitions at Mariner Wealth Advisors, have a recruiting opportunity through Mariner Platform Solutions, and then for those advisors that really want to build an enterprise, to be able to have a stake in Dynasty as Dynasty solving that, I just think it's a great opportunity.
Well, that's got to make you feel pretty good, Shirl.
Well, as I said, to have one of the best entrepreneurs, in the independent space, who's built a remarkable business, to come in and say, look, we'd like to invest alongside, and this, Tony, alongside of InvestNet. We're really excited about the joint venture that we're bringing to market later this year, the Advisor Services Exchange, to help their RAA and independent clients, bring some of our services there, and our legacy investors invested in this round as well. So it's a nice validation, but it just raises the pressure to execute and perform now that you have good friends invested in the firm.
Well, I'm not worried about that with you at all. So what I do want to talk about is something that Marty brought up, how he thinks this is at the beginning, because I sort of feel that way too. But we're at the beginning, and I thought if you would have asked me 2 years ago, I would have thought I knew where this thing was going to end up. I'm not so sure now exactly what it's going to look like, and I'm especially now that we're sort of living through this unprecedented, epidemic. No one, game plan this thing, right? And then we have the markets being so crazy. So let's talk a little bit, Marty. Next 12 to 24 months, not long-term future. You say we're still at the beginning, but boy, we've got a lot going on now. The impact of that on where you think this thing is going to go.
Yeah, and so you think about the movement of advisors.
Yeah.
I think that demand is being pent up right now. I mean, I think obviously because of the stay-at-home environment that we're in today, I think the can's getting kicked down the road a little bit. Since March 31st, so that's been 12 days. We've closed an acquisition of a $400 million firm in New Jersey and onboarded 2 advisors at Mariner Wealth. So all 3 of those are at Mariner Wealth. At Mariner Platform Solutions, our entire pipeline has been kind of, the pause button has been hit. Advisors are scared to move and to think about transitioning clients during this stay-at-home piece. It's different mentally for them to think, oh, I've got the stability of Mariner and I've got the stability of being an employee. But when they're moving and going into something they're going to own, I think that's going to break loose in not the too distant future. I mean, I think weeks, and all this kind of demand is going to just blow through.
Yeah, I think not only that, you've got there's an element, and I wrote about this, Shirl, which I know you religiously read everything that I write. That once these guys have seen Paris, they're used to working at home. There was also some fear, Marty, about if I work at home, it's not going to work. They told me I had to this, and now they're saying, well, there's a lot of different opportunities, right, Shirl? I mean, there's a lot of ways to skin a cat.
I think anytime you go through an environment like we are now, what you typically find is it accelerates trends that had already started, right? So people were starting to invest more in technology, and now they're being forced to utilize more technology. I think
Right.
people are already starting to make the move to independence. Frankly, I think this is going to accelerate it. Our phones are ringing off the hook. Advisors are saying, I'm frustrated because my compensation has gone down because it's tied to revenue and asset levels. Firms that I work for, these major public companies at the wirehouses, are pulling back investments in the firm. I now have to share, an administrative assistant with more people. I don't have as
Right.
much support in the home office. And then, oh, by the way, real estate, which is something that I thought was a big part of the value prop that I used to get, is now less important. So why am I paying 55, 60% of my revenue? Let me move to an environment where I can keep more of it, own
Right.
the equity in the business, have better technology, have more flexibility. So I think you're going to continue to see an acceleration. I agree with Marty, it's spring loaded. And I think it's also spring loaded on the RIA side in the M&A space as well. I think you're going to see a lot more M&A in the latter half of
Yeah,
the
I want to hear about that too. But one thing, Marty and I were talking about this while we were waiting for you, Shirl, of course. But we were talking about real estate, the same thing. I talked to a bunch of CEOs, and the guys who were looking at 80,000 square feet on Fifth Avenue, or 70,000 square feet on Seventh Avenue, now looking at 35 and 40. And we've had this field test that you would never have been able to. No one would have had the balls to say, let's send everybody home for 60 days and see if the Zoom stuff actually works, right? But we have, and it does. It's not going to replace everything. I get it. We're going to come back to offices, but not the same way. You think about large RIA, Shirl. One I talked to that does not work for you guys, but multi-billion-dollar RIA. He built this big RIA Eagle barn. His lease is up. It's $300,000, a year that he saves if he just gets out of his lease. He's just going to do a conference room and a couple of cubes, and when the clients want him, they're going to come back. And a lot of this, guys, comes from the 75-year-old client using Zoom to see their grandkids. Why are they going to drag their ass to your office if they can see you on Zoom, right? That's a big part of the change. Is the client, this third wall is broken down. Just like we're in your house, we see Shirl's in the bathroom. We see that you're in maybe a garage room, Marty. I can't quite tell what's going on over there, but we see that we're all, the third wall is broken down. There's a lot more connectivity, right, than there was. And do you need what we used to have? Not that it's going away, but not in the same way.
I think the short answer is no, you don't on the real estate side. But I'll tell you, I'm so excited about the positive change that's going to come about from investment and utilization of technology. We have, Marty was talking about some of the activity they've had. We have a large number of transitions. We plan to keep your writers very busy, Tony, in the next several months, where that has forced us to invest in remote transitions, right? So to invest more in how do you digitally onboard, right, through electronic signatures? How do you provide all of the administrative support with team members that might be working from home, right? I'm excited about it because we're going to get through this next 90 days. We're going to learn a ton as an industry set about how at scale, to move, lots of advisors in the future. And I think it's going to become standard procedure to move to a digital arena, whether it's from the custodian perspective, the TAMP, transitioning, onboarding clients. I think the industry is going to be in a much better place as a result of this, 12 months from now.
Marty, what are your thoughts? I mean, you got to agree that the smaller firms, the nimbler firms, the firms that were, using this technology before, you guys particularly, you have to have an advantage, right?
Yeah, I think, from our perspective, we have 42 locations, and our home office, HQ, if you will, I almost feel stuck, right? Because now it's such a big space, and lots of individuals are talking about their ability to not come in, and they're just they're just as productive. We haven't seen that fall off at all.
Right.
But as you look out at the locations and scattered all over the place, I think your example of just having a place that you can go have meetings when you need to, might be the new norm. But I say might because, we've had lots of conversations with advisors when this first happened that were so positive about, I'm working from home. Things are great. I'm working from home. And now it's like, I'm going crazy. I need people. I need interaction.
Right.
So I just don't know where it'll end up.
You know, we're sales guys. We need to be around people. That goes without saying. And that's why I think, I do think this digital transition thing is a big deal. And I think it's real because it has worked. And that would be one of the things I would have said before is not going to work, because I've been around a lot of nervous people making these transitions. So I'm wondering if part of this is if you leave a wirehouse now, everybody's spread out. They're not handing out your book like they used to, and maybe that's a little more difficult. But you're still going to have people who are going to be nervous, and they're going to want to see your face or Marty's face, the big ones, your face or Marty's face or somebody's face that they know in the office when they move too, So I think we'll end up with that sort of a little bit of both, I do want to talk about something that Shirl brought up too about M&A. I'd like to hear both of your opinions of that. There's been a lot of velocity, in this space. And if Marty's right, and we're at the beginning still, it's maybe, I would almost look at it like a Churchill kind of way, Marty, like we're at the end of the beginning. There's a lot more to go, but maybe we're at the end of the beginning with this COVID thing. So where do you think it goes on the M&A stuff?
From our seat, I mean, our pipeline is as big as it's ever been. We did 12 acquisitions in 2019, and our pipeline is bigger than it was then. So one of the things we've seen for call it $700 million and below, the number of firms on the buy side have declined. There's still, the regular players that we all know, the consolidators that are still there, but there's less firms that are doing mergers of equals or buying down, buying down just a little bit today. But I think they come back, when the volatility calms a little bit. But for larger firms, I'm talking to firms that are $5 billion and above. The private equity guys are just beating down their door. I mean, if Zoom has a virtual door, they're kicking it.
So now my other question, Shirl, what do you think? I'm thinking some of these private equity guys might have a different opinion as well, which is I wasn't expecting this kind of volatility. Our margins were slim. You think some of them are nervous and looking to get out of what they bought too?
I think absolutely, Tony. It's a great question. And we talk to a lot of private equity firms, a lot of investment bankers covering the space. And I think, right now might be a moment in time where what's happening in the underlying economy is a bit disconnected in terms of what's happening in the market. And I think there's a lot of private equity firms right now that are kind of pencils down, taking a wait and see approach. And I'm very bullish on M&A in the space going forward. In the ecosystem broadly, whether it's firms like ours buying the supply chain, consolidation occurring there, custodians obviously consolidating, advisor M&A as Marty was alluding to. But the big question for me is what's going to happen if things get worse, which they probably could or may before they get better. What happens to capital in the space, right? And I think those that have run really disciplined business and have a strong balance sheet and have great access to capital could be in a position to win in a massively disproportionate way 12 months from now, because I'm not sure that the space, which has historically been flush with capital, may continue to be if things get choppy over the next 12 months. So I think it's going to create an opportunity for businesses like Mariner and some of the other advisor firms on our platform, backed by us and our capital, where I think if they're really selective, that they could really grow quickly from an inorganic growth perspective.
So Marty, there's a lot of firms out there, that took advantage of the last, 8-10 years to start RIAs, and good recruiters that built these firms. But the margins have always been slim. I know I've started a couple of these firms, right? So the margins are slim. You think there's some firms that are getting shaky out there and that maybe could use a partner right now? Would love maybe somebody to come in, a little capital, help them recruit, and continue to grow.
Yeah, I think that's contributing to the fact that our pipeline is as big as it is right now. Yeah. I think that, we all know how the industry works from a revenue standpoint. It's a fixed percentage of your assets under management. Right. And, you watch a lot of us were fortunate enough that we bill in advance. So, the March volatility was scary to think about, if we would have had to bill on that at that point.
Right.
And I really do think it scared a lot of people.
Yeah.
Yeah. Well, unprecedented, right? That's the only way to talk about times like this, unprecedented.
Right.
What do you think about we talked about this a little bit about being nimble, Shirl, but to hit the next step of all the things you just described, how have you prepared your firm for that? And what surprised you guys maybe a little bit about what happened? It could be good or bad, for with your firms in terms of you have this double disaster.
Yeah. Well, just picking up on what Marty said, the other thing that's been and should be positive for our business, but what we're seeing with a lot of RIAs is an increase in outsourcing. And the reason for that is the biggest expense line item for RIAs typically is their staff. And we can talk about complacency in the breakaway space, where good can be the enemy of great and why an advisor may not break away. There's complacency in the RIA space too, in large part with RIAs over the last 11 years in the bull market have continued to staff up and in some cases not deal with, to your point, Tony, margins maybe not being as high as they should. So if your revenue is off 15, 20%, your marketing director or compliance director or ops director all cost the same, right? So if you're outsourcing it to a firm like Dynasty, now it's variable, right? So I think you're going to see more outsourcing, more people. When I talk about consolidation, it doesn't mean that you sell. Looking for synthetic scale to get the benefit, of a larger community and platform, I think is something that would accelerate. For the most part, the move towards remote work environment worked really well. I have to compliment our team. We stress test, the business. We run, trials to make sure that it works, and it has worked well. The challenge, obviously, is dealing with the emotional side of dealing with employees and clients, in particular, in pockets. We have a large office in Manhattan. It's hitting people there very differently than St. Pete, right? So I think we've all evolved a lot as leaders and learned a lot about the importance of communication, being present, the importance of meeting people where they are, and not taking a one-size-fits-all approach to managing your team.
How about you, Marty? Anything?
Yeah, I think he hit on a couple things that I think make a lot of sense. I mean, we talked about office space and things like that, but one of the things that we've noted that we think will happen, travel's probably going to be different. And this has forced us from a communication standpoint to adapt. And I'm doing weekly voice recordings, weekly videos that are going out to specific groups inside our organization about topics that normally I would have had to travel to go do, or I don't know if I would have had to, but I always did. I always traveled to their locations and to give those updates. And now I'm doing virtual office visits each week.
But I think that's one of those things we talked about. That's going to become accepted. I think people think that's okay, and they think it's okay today. And right, and then in the future, I think they're still going to. That's one of the things they're still going to think is okay. Marty's on the Zoom. I get it. I could see him. That could be a real positive for budgets too, right?
Yeah, I think so. And I think though that if you're focused on making sure that this isn't a time where you let communication, go backwards, that you keep in front of people, I think there's a lot to be learned from it. Great. I think it is here to stay.
Yeah,
I do too. Look, I appreciate you guys, being here. This has been a lot of fun. Anything that I didn't ask you about that you wanted to talk about, Shirl?
I would just add, from a practice management standpoint, we have this community, and we have a CEO, advisor CEO email chain. It's never been higher, and it's really been higher in terms of the interaction. And it's really been a great reminder that the best advisors in the independent space, they want to be independent but not alone, right? And even if it's virtual, having that community, being able to share best ideas in terms of how they're dealing with clients and staff and various technologies and how those are working. It's really, I think it's been wonderful to see how everyone has really come together and rallied as a community.
You've always done a really good job with that, Shirl, in terms of connecting with your advisors and everybody in the industry. You and I talk. You do reach out to people. I think that's great. Marty, how's your gang faring with it, and with this along the same lines as Shirl?
I think our gang's doing pretty good. I think one of the things that's been interesting to us that we talk a lot about is, for whatever reason, even though the market, tanked like it did, clients' response was almost more concern for how we are doing versus running for the hills. I mean, with the retention rates off the charts, that we're onboarding new clients on a daily basis. I mean, the client reaction hasn't been like it has in the past. Meltdown.
Yeah, but you know why that is, because you're a good guy, which means you attract good guys. That's just true. You attract brokers that are good guys and gals, and they have nice clients. If you get a broker who's a jerk, his clients are going to be jerks. That's the last guy you want. It's the truth. It's the last guy you want to hire. They're attracted to people who are the same as them. So it doesn't surprise me that you have clients that are, concerned about their advisors. I think that's
Thank you.
I think that's good, because look, their money's super important to them. So they rely on these folks. You forget how important a job we have as an industry and how important we are in people's lives until something like this. So. Look, I thank you both. There was another topic I wanted to get on, which was the whole thing with millennials. Marty and I, again, before Shirl came, talked about this. I thought it was a good topic where we have a terrible retention rate among millennials. I think all this Zoom stuff, it's going to get a lot better, and how, they're getting burned in this market because they tried to do it themselves, and it was, I'm going to sell when it's lowest, and I'm going to buy back in now that it's high again. So I think we've proven our value there. We can answer that. Look, this is my show. We can do whatever we want. So if you want to just comment on that, Marty, since we already talked about it.
Yeah, I think from a millennials, from an investor perspective or from an advisor perspective.
Well, both. I think they'll gravitate to advisors because of this. I think they've seen that these markets are too volatile to do on my own. I mean, my daughters were concerned about their 401ks. What should I do? What should I do? They've seen it go down. So you need human advice at some point.
Yeah, I do firmly believe that. I think I alluded to it just a minute ago, but our new households that we're onboarding on a daily basis if anything, it's gone up. It's definitely not going down. But the thing that's interesting is, we have 325 advisors. Our average advisor age is 45. We have a significant number of advisors under the age of 40. And that rank is continuing to grow, and we're continuing to attract that talent, which I think leads to us attracting the end client talent that fits that profile as well.
Great.
And Tony, I would just add a point on the talent side. I think, look, this is the advisor Super Bowl in terms of what we're living in right now, and this is a really good time for great advisors. The problem is we as an industry don't have enough great advisors. And whether it's millennials, we could talk about diversity and inclusion, attracting minorities or more female participants into the industry. We all, as an industry group, have to do a lot more than what we've done to attract, retain, and develop more talent. Because what we're seeing right now, as I said, is the importance of financial advice. It's critical. It's I think a national security issue, right? You could look at budgets at the national level, the state level, pensions and endowments. The fact that 70% of Americans can't put their hand on $500 in an emergency. The financial wellness of this country is not good and getting worse. And we need more talent, more diverse talent that looks like the clients that we're covering in this industry. So if this is driving positive change, to your point, Tony, that's going to attract more people to the industry, then I see that as a very, very positive thing.
Yeah. And I also think that it's not, because now we're down a different rabbit hole too, but it's independence is partly to blame for this too, because we used to have a big, Payne Weber had a big training program, Merrill Lynch had a big program, Morgan Stanley had a big training program. And a lot of those guys trained through, I trained at Merrill Lynch, right? So everybody trained at Merrill and then went on to do their own thing. But the independent world needs to start training. We need to figure out a way. I know a lot of schools are starting to have designations, which is a wonderful thing. I think you can get a degree now from a lot of schools and, planning and stuff like that. But we've got to figure a way, maybe it's a way to pool resources or something like that. I'll leave that to you guys to lead, but just give me credit for the idea that we need to do a better job.
This could be an opportunity for you actually to sponsor something back, the other way, Tony.
There's no, I get back every day. Are you kidding me? I'm a poor man. I'm trying to do this little AdvisorHub thing. Don't start taking from me. I'm the little guy. All right. That's great. Guys, I appreciate you being here. Thank you so much for your time. We'll do this again. There's obviously plenty more to talk about, but appreciate you being here.
Thanks for having us, Tony.
Yeah, thanks, Tony. Good to see you, Shirl.
Good to see you guys.
Thanks, Marty. See you guys.